Hello and welcome to Fidelity Connects. I'm Pamela Ritchie. North American equity markets are about flat today. This is after we saw equity markets getting a huge boost earlier this week with the US and China agreeing to a 90-day pause in their trade war. What is our next guest hearing from CEOs about the trade volatility in markets, and what investing strategy is he adopting as all of this plays out? Joining us here for a look at the Canadian investment landscape and how it's unfolding and how he's navigating today's markets is portfolio manager Joe Overdevest. Joe manages Fidelity Global Natural Resources Fund, among many other things. You dip into research. Welcome back. Great to see you.
Great seeing you, Pamela.
Great to have you here with us. Okay, so you and I spoke a few days ago, even a few days ago. Things are out of date.
Yes.
The world is wild and incredible deals are happening,
Yes.
actually. I wonder if we'll just sort of put the volatility question to you and ultimately how you want investors to kind of remember how to invest amidst all of this.
Yes, I think it goes back to what we originally said a number of sessions ago. Like, what was Fidelity doing even 6-9 months ago, even before Trump was elected? I think number one, we're analyzing, okay? We're adapting where we have to be, and we're keeping an open mind. And again, the same things I would say we're repeating now. So analyzing these new deals, adapting where there needs to be, and keeping an open mind, because it's a very fluid situation. Very summary for like the clients here, and I'm sure they feel it as well, is that there's certain things like COVID, which was an external event that you couldn't really control. But this is like a man-made event, as in like one person's tweet can change things one way or the other. And so you have to be very open-minded. I think that's very important, because it's very easy in this situation. I warned everybody a few months ago on this, don't get emotional, because it's gonna be a very fluid situation. It's very easy to get emotional going too negative or too positive. But right now, as we stand, as you said, the risks are being taken off. That President Trump...
They are, right?
Yes.
We're watching the bricks sort of risk coming down.
Exactly. There's a lot of things to unpack, but one of the biggest things we at least saw was fear. And you can use fear sometimes to your advantage. What I mean by that is, like, we've seen in different administrations, sadly, usually in South America, where a president will come in and say, this is my policy, and I don't care what happens. The currency cracks, and the fixed income market explodes, and they don't care. And then you have uprising, you have upheaval. At least this president has saw the currency market moved, the fixed income moved where they didn't want to go, and the equity market moved. And CEOs definitely came to visit the White House saying, just so you know, if you do this, we could have empty shelves, we could have high inflation, we could have job losses here in America if you do certain things. And then the Trump administration has been taking off the worst case scenario, and the market has been responding. But again, for this audience too, I'll also summarize, there's a lot of volatility. There's some great compounders that you and I have talked about in the past are up year to date, even all this. Dollar stores, property casualty insurance, waste companies. So we just have to sometimes take a step back and sometimes maybe try to ignore some of the headlines to what degree you get emotional about, and more importantly, understand where are the best companies.
But that said, the tariffs have been, it feels a bit sort of omnipresent for some time. You talk about the compounders, but the tariffs are something that companies have to really move on. Are the compounders able to battle the tariff story?
Look, it all depends on the quality of the business and probably the quality of the management as well, because even them, I've met with probably 10 CEOs and many of industrial ones even this morning and this past week alone, and everyone says the same thing, almost what I just said. You have to.
You just came from a conference.
Yeah,
right?
just
walked you out to come here to talk. Thank you.
And they're analyzing what's coming out. They're adapting, but they're keeping a very open mind. But you're right. I mean, I think what happens is, depending on the business, some of these businesses I mentioned, like property and casualty insurance, waste companies, dollar stores even, they're not really that affected by tariffs. It's to what degree you're affected. I will say almost every company we talk to these days, tariff comes up. Even ones that are not really affected, because they're saying that the second derivative, that also...
So the exposure is one thing.
Exactly. They may say like, well, we're seeing nothing directly in our business. We don't pay any tariffs, but we're worried that like our customers will be uncertain of the economy and then buy less goods. I would say, again, we can dive into some of this, so you really have to watch the blue part of the flame. And you and I have been talking about resources over the years. We always say the blue part of the flame is the hottest part. You got to watch in resources. When you invest, you want to be in there. But when you're with tariffs, you don't want to be in the blue part of the flame. And so for Trump, it's autos, it's farmers, which is probably dairy, it's steel workers, and any really manufacturing. Those are still tough, that like you got to watch those sectorial tariffs that could target you, which is what autos are dealing with right now.
Okay. So, I mean, we know about sort of a freeze on investment. The CapEx story is a little bit frozen for now, maybe even hiring and so on. So, I mean, does that mean you stay away from those areas? You're just limiting exposure? Tell us a little bit how you traverse this.
Yeah, it's when we talk to CEOs, first of all, there's two parts that the general feedback is yes, almost a pause depending on the company, but everyone's a little probably, again, second guessing everything in terms of hiring and capital expenditures, just because there's so many uncertainties. Like I said, that, even if you're not affected directly, it was such a big move that first tariff hit that if they went through as if the global economy would be hit, right? And then there was ramifications of that in terms of currency and even, of course, in fixed income markets. So, but I would say when we come to the investing part of it, I think with our portfolios, again, I think Fidelity does a great job of trying to find good companies as opposed to trying to make a big macro call. And this is an example why you don't want to, because literally you could wake up and the tweet, some days I don't even wake up, it's midday, a tweet comes out.
Right.
And
the markets are still open. What's going on?
And it's 1 p.m. and they said, you know what, we're backing off. But that's why you have to be really fluid. I would say though, when you're investing, you got to watch how much the portfolio has some sensitivity and just at least respect the upside downside of those individual securities. Again, there's nothing, you always want to keep an open mind that like sometimes the stock maybe have come off so much, so much is already priced in that it's actually attractive. Okay. But I would say there's a lot, like even we had discussions this morning with the CEO, and I will say, I said, like, what if you do this? What if these tariffs come in on Canada? What if these tariffs come in? Like, how do you deal with that? Are you raising prices? Are you moving your production to the US? These are very big questions for some of these companies.
Okay, so let's go to sort of the energy side of things, and we'll come back to other pieces as well. But so oil prices are a nice cushion for the economy globally. Actually, they've come down significantly for lots of reasons that we know. With that said, there's a big energy story in Canada that we think might get built out, but we really don't know. Take us as an investor, how you're looking at a new government, some promises, but legacy issues as well. Do you dip your toe in there yet or what?
I think the energy companies in general look probably more attractive here just because the oil prices come off. Low 60s is attractive, and we're actually seeing for the first time in many years the Permian, which was the biggest driver of oil growth, which is Texas oil basin, dropping rigs. And so Diamondback Energy, which would be one of the premier companies in terms of size and growth, they actually are, drop back their capital expenditures. So that's a good sign. So it means supply is starting to adjust. For commodity, you usually get more bullish there. You want to see that what we call the marginal cost of supply, right, is starting to adjust. So when we go back into Canada, you made a great point. We're starting to hear headlines as of this morning that maybe the Liberal government will be more friendly to oil and gas. I would state right now, talking to oil and gas CEOs, I think they are happy. They are receptive. I think, though, trust is earned by action and trust is earned over time. And so I think they're watching very much the actions of the Liberal government and making sure that's consistent over time. One of the bigger things that the audience might ask, then, what does this mean in terms of capital expenditures? I would say oil and gas drilling in Canada, I wouldn't really see a big change here because they're more sensitive to the oil price. And oil price being low 60s, most oil and gas companies aren't very excited. Even Canadian Natural Resources recently brought their capital expenditures down a slight amount. But on the margin, probably people are cutting, not adding. The bigger issue, though, is, as you're alluding to, is the big projects, oil pipelines, LNG, Canada.
To supply potentially Canada, but also to diversify away from the US. What's the talk?
Right now is that it's positive in that probably for the last few years, that talk was at least non-existent.
Don't bring it up.
Don't bring it up. So at least now it's being talked about. And so these are long-term solutions for Canada, which is positive because part of our tough negotiation with the US administration is that really the biggest tool we have is energy. But if we shut down the energy, it probably hurts us more than it hurts them. Right. So what you really need is longer term is we need to bring oil and gas outside of Canada. And that's oil pipelines, that's LNG. We have the ability to do that. I would say it's still very political in that oil has to probably cross maybe Quebec if you want to do expansion that way. And so for past pipelines, for this audience may not know, but some of those pipelines have been proposed in the past and been shut down. And
we hear about an energy corridor across the country. That seems to be also a discussion somewhere.
Yeah, and I think it just right now it's low probabilities of crossing multiple certain provinces just because, again, there's a sensitive history. And at least in Canada, again, we're probably different in America that way, and is that we're not forcing certain provinces, whereas America might do that. That's not our style to do that. But I do think on the margin, we can definitely expand, TMX pipeline in the West without a lot of...
It's already there.
It's already there.
Just make it bigger.
And LNG Canada, we can expand that as well, which would help our markets, yes.
Okay, really interesting. Talk to us a little bit about, so the deal with China, we don't know exactly what it meant, but it's obviously calmed the markets. There's discussions. Geneva was the place. I hope they had great chocolate there where they had those conversations. But the discussion of, for instance, port holdups, China kind of dumping things into third countries, sometimes Canada, others as well, so they don't get the punishing tariffs of landing at the US ports and so on. There's going to be, some are calling it comparable to the COVID supply chain mess ups for a little while. Again, do you just stay totally clear of that? Is there an opportunity to take a look at transportation, be it by rails, trucks, whatever, because they can charge more right now? There's going to be an opportunity. Tell us a little bit about the supply chain story for the next, 6 months or something.
Yes, we were meeting with the largest, let's say, rails in North America the last few days.
Oh, good. What did they say?
and we're more importantly, even the dollar stores we've been meeting with and the buyers of some of these goods. So first of all, I would say it's subtly, but some of our companies may benefit, like a dollar store may benefit because guess what? You don't want to pay a tariff sending your goods to the US dollar store. So on the margin, you might go to Canada
Stop in Vancouver.
Yeah, we might have a better deal for you, right? As opposed to a 30% tariff, for instance. And then I would say for the rails in general is that, I would say they would watch still. The only thing I would say is that for Canadian rails, they still go in the US and they still want the US to do well. So Canada is just part of the story. But I would say the bigger question for you is that, you said about supply chains. I think there was a key meeting that went on with, the Walmarts of the world, the big retailers went to Trump and said, you know what, if you do this, we might have empty shelves because the costs are so high that we're not even going to put on the shelf because no one's even going to buy that product. And so you have to understand the ramifications of this. And those are stockouts and those are massive inflation. And
we had talks in Geneva like that.
and so, yeah, I would say we'll see if we avoided this. And I think there's a bigger discussion too of soft data versus hard data. The economic data right now that's coming out, soft data is negative. Right. Is that if you look at CEO optimism, consumer optimism, anything with someone how they're feeling is not good right now. But if you look at the hard data,
it's okay.
Jobs, inflation's coming down right now. All these are still okay. Now that's the echo effect because all this tariff noise, this uncertainty, usually hard data takes longer to take effect. And it could actually show up in the summer. And then the question for you would be, do you think the market worries about that? I think the market worries about it, but it will depend on the severity of it. And more importantly, what are tariffs at that point? Because the market is a discounting mechanism. If the market sees hard data in the summer, but the tariffs have come off, we have deals, they generally will look through that again, but it's all the magnitude and of course the tariff deal when it actually comes through.
Okay, that's really interesting. Yeah, because it does actually seem like Q2 is sort of, people are at least expecting it to be possibly tricky.
Yes.
And so there's a known unknown there, certainly. Let's talk a little bit about the rest of the Canadian economy, the consumer story you've mentioned, the economic data, generally speaking. Canadians seem to be okay so far, but there's also lots of discussion of a recession. Has that been alleviated? Where do we sit in that in terms of investment?
Look, I think even for Canadians, the biggest thing is probably still tariffs, is that even there's an indirect effect of what US will do with other countries, of course a direct effect with us, is that as of right now, there's a elevated risk of recession, but it's actually generally low because you're seeing anemic growth in terms, we still have positive GDP growth, we have inflation that's under control, interest rate cuts in the US, there's 2 priced in, there's 1 in Canada. The reason why there's 1 in Canada is just because, not more, we've already cut so much. But probably the biggest thing they were pausing on, all these central bankers cutting more too, is the uncertainty of tariffs because it's inflationary, so you don't want to cut too early. But the Canadian consumer, because they have their jobs right now, is generally okay. The banks will report end of this month. Don't be surprised though, because what the bank will do is take in economic data into their risk models that they may lower increase their risk of recession, which would increase their PCLs or their credit losses.
They might hold on to more.
Yeah, because again, we have to understand that like the economic data we're seeing is getting a little weaker on the margin.
Sure.
And but I would say more importantly, as though we're not actually in a recession, we're just in a almost uncertain time, and more importantly, people still have their jobs. Yes.
Okay, really interesting. It's interesting that we don't talk about interest rates. You mentioned there, they don't need to pull the trigger, perhaps Bank of Canada yet, until we see things. But it does seem to be a little bit of a sideshow at the moment, the interest rate story. Is there anything in there that you're watching carefully?
I would say,
are we at an okay level?
To your point, yeah, we're probably it is a sideshow, because here's a simple thing for the audience is that the U.S. Federal Reserve, the estimates for central bank cuts for the U.S. was probably 4 just a week ago, and now they're down to 2. And what's the difference is because of tariffs. Tariffs are overcoming everything, and sometimes the audience may say, I want to hear more not tariffs, and I agree, but for our CEOs and for the central bankers, it is still the biggest thing on the market in terms of like affecting all currencies and all fixed income and equity markets.
So what is your read on markets right now in terms of a little bit of a coming back, the animal spirits story? There were rumored to be all kinds of exits going on from either private equity or different ways of lockups, and we'd have a whole bunch of IPOs. That obviously got a little bit sidelined for obvious reasons. We've seen actually some big commodity deals recently. We saw a silver deal recently. Is it all coming back? Deals, IPOs? How are the capital markets reacting, even just in the last week or so?
Yeah, great question. We had a few updates with some of the big private equity players.
Okay.
And so I would say private equity, in general, exactly you said, they were hoping for more, and I think the whole market was hoping for more. And of course, because of tariffs, animal spirits went down, confidence in the markets just obviously went down. But we're seeing is potentially non-thawing, and almost like things
recently, right?
Yeah. The market, as we said, needs time and action, as in like to gain trust back, just like anyone else. And so as time passes, as tariffs start coming off, I would see very recently you're starting to see that M&A is starting to creep up, equity deals are starting to happen, IPOs are starting to happen. That's healthy for the market. Private equity, the next step will be starting to sell some of their assets and then recycling and buying again. So the subtle moves have been happening. They are feeling a little more confident, yes.
Okay, it's really interesting. So let's go further into sort of materials broadly. We talked about energy. You take a look at natural resources, North American-wise. There's copper stories. The copper story a couple of months ago was very much, get it out of London, get it into the U.S. before the tariffs hit. And then we assume that there's some fairly serious warehousing going on.
Yeah.
Again, how do you look through that? Do you need to look through that? Tell us about natural resources right now.
Yeah, the big buckets, oil would be, obviously it's lower now, but probably a little more attractive because we're in the low 60s. We're actually starting to see supply come off. Copper is still pretty attractive. I would say, again, the biggest swing factor will be China. China was, its tariffs is really going to affect them. Now they've been very keen to explain to everybody in the world that we're not going to back off because we can inject money into our system. We don't have a mid-November election to worry about. Right. And so they're not backing off in terms of almost stimulating the government actions to help their people just in case tariffs do hurt them. So that's good because, again, the supply side of copper, we're not really seeing much at all.
Right. Okay.
I would say, though, gold is obviously brought up a lot. Is that gold?
Has it peaked, Joe? Can we put you on? Can we make news here?
Look, I think we're supposed to avoid headlines on these
no headlines. Yeah, okay.
But no.
It's been an interesting trajectory, though. Gold.
But here's what I'd say on gold is that what drove us here: central bank buying, people concerned about tariffs, people just concerned about inflation in general, maybe being a little sticky.
Even Russia, Ukraine a bit, right?
Russia, Ukraine a little bit, yeah. So probably some of those tenants are starting to come off, right? Okay. People are probably a little less worried about inflation now. The tariffs are starting to come off. So that's two right there. They're almost combined. And then, Russia, Ukraine, hopefully for the world, we have a peace deal at some point in time. The central bank buying, I wouldn't be surprised though, still keeps creeping up because that's like, to be blunt, you and I have talked about when this originally happened too on this show is that when the tariffs came up, it almost maybe led to more distrust for the U.S. administration going forward, which would mean then, of course, central bankers leaving the U.S. dollar on the margin going forward and more to gold or other alternatives. And so that tenet we still have. The biggest thing for gold for this audience, though, to understand, gold does well when things are uncertain. Right. So if the market or animal spirits do come back, usually that's the offset kind of thing.
If we reach peak uncertainty, we might come down the other side.
So the secular trend of central bankers buying may still be there. But just understand that almost the cyclicality or concerns start coming off. you will have some short-term headwinds.
Well, so one of the other things that may come off with some of the tariff story just quieting down a little bit are the other tenets of the Trump administration, which are the deregulation, which are also tax cuts. Those are being discussed right now. It does seem like aspects of the administration is trying to move on to deals, deregulations, the discussion of tax cuts. Again, what does that do for us, for investors, for the country, but also sort of the broader picture once we move on to those things? That was the original Trump win rally, wasn't it? Those sort of three things.
Yeah. So it's interesting you say that. Well, there's two parts to that. Number one is actually, I would say, even what we do before, we're saying like analyze, adapt, and keep an open mind. When the Trump numbers came out, what do we do here at Fidelity? The analysts look at their companies and go, okay, because many of our companies are global champions, and they actually have operations in the U.S. So, okay, what tax benefits do they have? How much is it? What percentage of their cash flow could be benefited from this? So we run the numbers. In some companies, it's pretty beneficial, actually. But then the second part of that is that, part of this administration came in, like you said, and we talked about this before, is that they wanted to bring down the deficit. And you actually look at the numbers of that tax bill, that's a pretty big tax bill. And, they wanted to make some government cuts called DOGE. Well, that is so far not probably been to what they want. So you're actually starting to going back to the deficit, they haven't really solved the deficit problem. And so this is an interesting part of the market is that you may get a good times here, but at some point in time,
they're going to have to pay the tax. They're going to have to pay the bill.
You have to pay the bill. And the timing of that could be delayed or like that. But I would say for market participants, certain people I've been talking to the last few days, again, the timing of this can be very long dated and they still have time to adjust, but they still really haven't solved that. And actually dovetails what you just said about gold, because gold may actually, one of the things that would make gold really do well is people, start worrying about the second derivative of all this is like, oh my, like if they can't, fix the deficit issue, they have to essentially paper over the problem, which would be very bullish for gold.
Right, would be very interesting. What would, and again, we're doing this on the eve of, we think, a conversation between Ukraine and Russia. We don't know what's going to happen there. But in theory, what would it do basically to oil markets, to natural resources markets, maybe even to, potash? There's lots of things we could talk about there. But if there was a thawing, what might it mean for investors? Is there anything that you want to take a look at for global prices there?
Yeah. The Russia-Ukraine on the margin should help bring more supply, which may put pressure on like agriculture fertilizers like potash. Mm-hmm. But I would say it's been going on for so long. Some of these countries, much like when we put oil sanctions on different countries, they find ways to move it still within the system. So they've had a
nice run with India. It's done very well for them, actually.
So the materiality of actually the impact is probably limited. And then, of course, oil, they just move the oil in different areas, in particular like China. Probably the bigger one would be natural gas. Is that if the Europeans want to take their gas in a bigger way, then that would bring down probably world natural gas prices a little bit. It's still very regional, but more importantly, LNG prices or European prices, which are about $11 plus, which here in the US or Canada would be, $2, $3, $4, depending on what hub you're at, is that you could see that $11 come off, yes.
And so would that, again, affect sort of our prospects of some version of LNG diversification around the world?
It'd still be attractive for LNG because we were still like looking to do LNG Canada or LNG deals like that, and the US and Canada before this Russia-Ukraine situation happened. Okay. And so just having prices that are above obviously $3, $4, and you start doing high single digits even, are still very attractive.
Question, what are your thoughts on green energy moving forward?
Green energy right now is that, it does have some headwinds. And you and I have talked about this over the years. You have to watch when you do investing is that, how much are you relying on the government for a subsidy or tax break because the government can change their mind. And the U.S. administration, back to, what your original question is that right now they're pulling back. And so you really have to watch, are you, owning a company that's actually competitive ex-government benefits? Because right now, I'd be worried about that with the U.S. And a lot of the green energy is connected to the U.S. Even if it's a Canadian company, the biggest market is probably selling into the U.S. So is green still in demand? For sure, it's still in demand, as in like, in terms of non-carbon energy is still a big deal. In particular, uranium is one of probably the biggest things we've seen in the last few years grow. Wind and solar is still there. But I would say when we talk to the alternative energy companies, they're very uncertain with this government. And that makes it very uncertain for even their customers or investors to stand behind them because you don't know where the U.S. administration will decide on this. But right now, they don't seem to be too friendly towards this sector.
Okay, interesting. We talked a lot about U.S. exceptionalism in the sort of recent weeks and money going in other places to the international markets. Who knows whether that'll come back a bit or not. There does seem to be, as you say, a slightly more positive outlook just in recent weeks. Where does Canada fit into this story? Are we going to sort of snap back with more flows back into the U.S. if that's in fact what we see? Do we benefit from an international regime shift is really what we're talking about?
Look, I think a lot of people like saying things like they're definitive, and often the world is a gray scale, not yes or no, as in like the U.S. is going to lead or Europe's, U.S. is dead or such like that. Look, the U.S. has done an amazing job, and the Canada has done an amazing job. Let's put North America together. Again, ironically, Canada is leading the U.S. market in terms of stock returns quietly year to date. And when it comes to both countries, rule of law, great education, people want to go to Canada and U.S. Like immigration, we're trying to control it. As in other countries, people are leaving, our population is declining. And more importantly, we have capital markets, we have technology companies, we have people who want to grow companies, start companies, and we have an environment in Canada, US, where we actually foster that, which a lot of these other countries don't have. And so, yes, for short term, you can have like leadership changes, but those tenets are still there. And so for Canada and US, as a Canadian, you actually want to see, Canada and U.S. do well together because we are trading partners, and that's what's being brought up with this tariff stuff. Why it was so disruptive to us, because our biggest trading partner we want to see succeed because part of their success is our success, and we share as partners. And so that's what we're hoping for. And again, the one thing I'll have to watch for this audience is that as we go forward, understand that right now we have 0% tariffs, but our negotiations are still ongoing. We may have 10% because everyone else seems to be getting 10%.
10% seems to be a bit of
it almost seems like a baseline. And that's where I think we're trying to keep an open mind as investors. Don't be complacent just because we currently have 0%, that may change because, we're still in negotiations, yes.
Okay. Does it look like CUSMA, USMCA, NAFTA, whatever we want to call it, is the renegotiations are not going to happen next month?
It's a great point. The timing of this, I actually asked some certain big CEOs the last few days who probably have some kind of insights, at least of the companies that are talking to U.S. administration, or they themselves are talking to U.S. administration. They were putting out dates that, it is long dated. It could be something into next year, actually. And the reason why is because from our U.S. administration perspective, the priorities for them, of course, are China, now Europe, Southeast Asia in general. Right. Canada really isn't actually, which is a good thing, their biggest concern.
They have other fish to fry.
The other fish to fry, and we'll take the 0% we have right now, but it is something that will be a long discussion, especially with the new Liberal government.
So let's come back to where we started off, which is, I think on some level you mentioned the compounders still are okay in a world of tariffs. They still perform ultimately, and you mentioned off the top, property insurance within financials. Where else can you sit right now and look at that compounding story?
The compounding story would be property and casualty, great stories there. In the industrial space, you have waste companies, you have auto salvage companies, you have engineering companies. Even in the software space, there's some great companies in the vertical market software space there. So I think dollar stores as well in consumer discretionary, or even just grocers in Canada. So I think in Canada, that's the benefit, is like there's so many great companies. Many of them are global, some of them are Canadian-wide, and they are great compounders run by great teams and great companies, and they can often overcome very big macro issues. And so those are companies that often get us excited.
Okay, it's a relief to have this time with you to take us through the fact to just hold on through some of these rocky seas and the compounders do their trick. Joe Overdevest, thank you for joining us.
Thank you.
Thanks for listening to the Fidelity Connects podcast. Now, if you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/how-to-buy for more information. On fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on X. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently, and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks for tuning in. We'll see you next time.